Thank you very much. Let's get back to the markets now. David Stryzewski joins me. David, good morning to you. We have kind of a bear market rally. It's not much of one. We're waiting for Jay Powell today. But where do these markets go? We have inflation data tomorrow. We have the jobs report on Friday. All sorts of things for investors to contemplate.
Well, good morning, Ashley. I think if you get the consumer right, you've got the future right. And so as we look at the consumer today, we just had sentiment numbers come out, and those sentiment numbers are at recession levels. And so, you know, that's concerning. We're obviously seeing the unemployment begin to happen as we're seeing, you know, some seasonal jobs come in right now. And so we've got a little bit of a mixed number on that. Again, I think that we'll see some of that begin to taper here into the new year. But I think the markets are in the middle of a bear market rally. I vote it goes up forever. You know, here's the reality, though. What goes up ultimately does come down, and we've got some cooling off going on. So I'm very cautious right now, although we have deployed some capital from cash reserves, and we're participating in an awesome way right now.
Well, we had the JOLTS number this morning, 10.3 million open jobs. Remarkable. We have a little over 6 million people looking, so you're not going to be able to fill all of those open jobs. It's a very tight labor market, and that's keeping wages higher, even though, you know, companies are being forced to lay people off right now. But, you know, this economy is a little out of sync, and I know the Fed's doing what they're doing to try and get it back on track, but how long does this turmoil go on in the economy?
Well, if you ask most CEOs today, and some of these sentiment conversations been had with them, better than 50% believe that 2023 is going to be a recession. Better than 50% also believe that it's going to be extended for multiple years. And so if we look at things like interest rates is what the Federal Reserve can affect. You know, when the interest rates go high, that affects everything. And those rates are sticky. They don't just come down to 3% levels. That was historic. Okay, so we're at 6.5 right now on a 30-year. You know, corporations have to borrow at higher rates today. And so that's actually going to completely change the economics of how we've been funding deals, how we've been buying equipment, how we've been in growth mode as a nation. And I think that that's really shifting right now. And so as we look at some of these numbers, it is very concerning because the consumer here, yeah, they're getting 5% wage increase, but if inflation's above that, you're ultimately losing. If interest rates rose above that, you can't afford a house any longer. And so a lot of people are coming into this fourth quarter, I think, with just the last bit of cash that they have, as we're seeing credit card going up. And a lot of the middle class families, which are the ones I'm most concerned about, are just getting hammered.
And we also just heard, David, from the CEO of Bank of America, Brian Moynihan, and he's predicting 2 more years of pain in the housing market. Listen to this.
That was predicted to happen this year, earlier this year. There was going to be a real slowdown. The Fed was going to raise rates, and it's all pushed out largely because of one thing, which is the U.S. consumer. You have to slow down the economy. You have to slow down inflation, and the way you do that's raising interest rates. That'll happen. That'll take almost 2 years.
2 years of pain for people trying to rent or buy a house.
2 years of slower activity.
2 more years of pain in the housing market. That's pretty brutal. What do you think, David?
Well, what the Federal Reserve has done is the equivalent of major Richter scale activity. And so I believe that he's right. You know, we've got to have these rates come down. Every 1% that these interest rates rise is a 10% more income if we're going to buy the house at that same value. And so these deals are falling apart because people were qualified and then now they're not at that current rate. So as we see that rate begin to taper back over the next few years, which is what their trajectory is, then yeah, maybe we're going to see more activity. But as it sits right now, I see the housing market just very dead in the water here today, and the air's coming out quickly.
It certainly is. You can hear it hiss right now. All right, David Stryzewski, great stuff this morning, David. Covered a lot of ground. Thank you for joining us. We do appreciate it.
Thank you, Ashley.
Let's look at some of the